Silver futures margins jumped 50% overnight on December 11th, 2025, from $22,000 to $33,000 per contract at the CME. Yet the price ripped through $65 the next day, hitting $66.52 by December 17th. Physical premiums on 1-ounce Eagles climbed to $8 over spot in major hubs, while COMEX deliveries spiked 300% month-over-month, draining registered inventories to 45 million ounces, barely 2 weeks of industrial pull. Backwardation widened to $3 between spot and March futures, a spread that hasn't existed since 1980. This isn't volatility. This is the paper market detaching from physical reality, right now, as banks trigger their kill switch and watch it backfire in real time. The system designed to contain silver is fracturing at the seams. Look at the mechanics. Bullion banks, led by players like JP Morgan with their $920 million manipulation fine from 2020 still fresh in the records, rely on futures to anchor prices. They short paper contracts at ratios exceeding 300 to 1 against physical holdings, creating an illusion of abundance. But when industrial demand, solar panels consuming 5,200 tons this year alone, EVs pulling 50 grams per vehicle, data centers at 1.2 kilograms per rack, meets 5 straight years of supply deficits, peaking at 206 million ounces in 2025 per CPM Group. Estimates, the illusion cracks. The CME's margin hike was meant to force liquidation, trigger margin calls, and crush leveraged longs. Instead, it exposed the disconnect. Spot prices in Shanghai trading $8 above COMEX, arbitrageurs airlifting bars across the Pacific, and lease rates spiking to 32%, levels unseen in decades. The kill switch activated, but the engine kept running, faster. This mirrors 1980, when the Hunt brothers pushed silver to $48 nominal, $199 inflation adjusted today, before exchanges flipped rules to liquidation only, crashing the market overnight. Back then, the system held because physical demand was speculative, not structural. Now, industrial offtake accounts for 64% of consumption, up from 50% a decade ago, with photovoltaic silver use alone projected to hit 7,000 tons by 2027 per Dongxing Securities. The banks changed rules mid-game again, but this time, refineries are at capacity bottlenecks, mine output down 7% since 2016 peaks, and recycling up 24% to 195 million ounces, can't bridge the gap. Where 1980 was a speculative bubble popped by regulatory fiat, 2025 is a supply chokehold amplified by the same fiat failing. The anomaly here isn't the price surge. It's that the surge persists despite the intervention, signaling the control mechanism's obsolescence. Geopolitics amplifies the break. China's export controls on silver-bearing materials, implemented mid-2025, rerouted global flows, while U.S. critical minerals designations locked domestic output into strategic reserves. Add Russia's reserve additions, first physical silver buys in decades, and Saudi Arabia's SLV ETF purchases, and you see institutions pivoting to metal as dollar dominance erodes. The logistics chain buckles under this. Transatlantic cargo flights booked solid for bars, premiums in India hitting 15% as investors buy into the rally expecting $100 by 2026 per Bank of America targets. This isn't coordinated conspiracy. It's emergent chaos from a system where just-in-time supply meets just-too-late demand. The tiptoeing silence from regulators, SEC position limits unenforced, CFTC reports delayed 6 weeks during the government shutdown, speaks volumes. It's not oversight, it's avoidance, because acknowledging the rift means admitting the paper edifice is crumbling. Consider the behavioral signals from large players. JP Morgan's leasing halt in October 2025, stopping SLV share lends for physical redemptions, wasn't benevolence. It was self-preservation, preserving vaults at 501.9 million ounces, while ETFs like SLV absorbed 95 million ounces in H1 alone. Institutions aren't dumping, they're hoarding, with central banks adding silver to gold stockpiles for the first time since Bretton Woods echoes. This shift from paper to physics exposes the vulnerability. COMEX's 378 to 1 paper-to-physical ratio becomes untenable when deliveries jump, as they did 40% in Q4. The kill switch failed because the underlying system lost elasticity. Deficits aren't cyclical anymore. They're baked in, with mine supply inelastic to price. Only 28% primary silver mines globally, and industrial demand rigid. Here's where the logic snaps. If backwardation at 20% annualized in October didn't resolve through arbitrage, what mechanism remains to reconnect spot and futures without a price reset upward? If you've tracked futures curves or seen delivery data firsthand, drop your take in the comments. Does this backwardation feel like 2020's COVID squeeze or something deeper? And why? Your observations from the trading floor could clarify where the next fracture hits. The consequences cascade beyond markets into real infrastructure. Silver's role in military tech, missiles, radar, batteries, means shortages ripple to defense logistics, where U.S. stockpiles, already strained by 2025 export bans, force reallocations from civilian solar to strategic reserves. This isn't hypothetical. It's documented in DoD reports flagging silver as critical, with 2025 consumption up 15% in EV and AI sectors alone. The system's loss of control manifests in chain reactions. Refineries like Perth Mint rationing output, premiums decoupling regional prices, London at $4 over spot, Shanghai $8, and volatility spiking without corresponding fear gauges, VIX at 18, while silver swings 10% daily. Compare to 2008, when gold backwardated briefly amid credit freeze. Silver's current inversion lasts months, not days, because the deficit is structural, not financial. Earlier mechanics worked when supply could ramp. Peru's output up 10% post-2010. But now, maturing ore bodies and ESG constraints cap growth at 2% annually, per Silver Institute. This de facto repricing pressures the entire chain. Fabricators in electronics pay 20% premiums for prompt delivery, passing costs to consumers, while miners like those in Kosala aim for 2.5 million ounces at $10.80 AISC, profiting but unable to scale fast enough. The fracture point? When paper shorts cover en masse, as in 2011's 40% rally post-spoofing scandals. Banks's kill switch, margin hikes, trading halts like November's glitch when silver hit $54, buys time, but each failure widens the gap. The Hunt era ended with rule changes because the system could absorb the shock. Today, with 1.2 billion ounces demanded against 1.05 billion supplied, absorption fails. Tie media blackout on this. Major outlets glossing over the $3 spread as volatility is its own signal. Like 2016 Venezuela, where asset prices detached before hyperinflation hit. For those in manufacturing or supply chains, if you're seeing silver allocation delays or premium spikes in your operations, share in the comments how it's altering your projections. Does it match the official deficit numbers or feel worse? The narrative inverts cause and effect here. The margin hike wasn't a response to excess leverage. It was a preemptive strike against physical drain, but it accelerated the detachment. Hunt brothers faced liquidation only because their corner threatened banks. Now, banks face the corner from solar farms and data centers, non-speculative users who can't be margin called out. Geopolitical undercurrents, India's 2025 tariff escalations disrupting chains, China's 3.0% inflation, allowing silver imports to surge, compound this, turning logistics into a bottleneck. Airlifts of bars aren't efficiency. They're desperation, costing 5% premiums just for transport. History as mirror. Bosnia's 1990s siege saw functional items trade above gold. In 2025's silver squeeze, industrial users hoard scrap, recycling jumps 24%. But it's patchwork against 149 million-ounce shortfalls. The scale emerges progressively. What starts as a futures anomaly becomes a supply crisis, then a systemic one. 2025's 117.6 million-ounce deficit, down 21% from 2024 per Silver Institute, seems narrower, but it's illusion. Industrial demand steady at 680.5 million ounces, jewelry down 16%, yet total supply up 3% to 1.05 billion can't close the gap. The kill switch messed up because it assumed paper dominance. Physical's revenge is the $8 Shanghai premium, forcing global repricing. Regulators' silence? Not incompetence. Calculation, as probing the 300-to-1 leverage risks exposing the edifice. Military angle. Silver in quantum tech. Radar. Shortages delay deployments, as seen in 2025 U.S. reports flagging EV battery constraints. If you're in defense or tech sectors and noticing silver input costs reshaping budgets, weigh in below with your ground-level view. Is the deficit manifesting as delays or full reallocations? Deeper, the pre-break mechanics reveal why sustainability crumbles. Pre-2020, contango allowed storage costs 50 cents to $1 per ounce annual to embed in futures. Now, backwardation at 20%, annualized flips that, rewarding holders who withhold. Banks' response, hiking margins to 45% for December contracts, aims to shake weak hands, but strong hands, institutions at 1.13 billion ounces in ETFs, hold. The 1980 mirror distorts. Then, speculation drove. Now, fundamentals do, with AI cabinets alone adding 1.2 kilograms demand per unit, scaling to millions. Logistics fracture. Perth Mint's rationing echoes Venezuela 2016, where basics traded over assets. In systemic loss, value shifts. Fire starters like disposable lighters become currency. Trading for weeks' food in Yugoslavia collapse, because reliability trumps rarity when grids fail. The progression clarifies: symptoms, margin fails, price rips, precede causes, deficits, demand rigidity. But inverting reveals the core instability. Paper's over-leverage meets physics limits. 2025's 63.4 million-ounce deficit per metals. Focus isn't anomaly. It's new normal, with 2026 at 30.5 million still short. Banks' overnight rule change exposes desperation, but the mess-up is irreversible. Once physical sets price, as in October's 20% backwardation, reconnection demands higher equilibrium. Geopolitics weaves in. Saudi SLV buys signal petrodollar pivot, while U.S. shutdown delayed CFTC data, hiding positions. History reflects. World War II saw needle thread sets save lives via repairs. Now, silver's medical use, antibacterial, like hydrogen peroxide alternatives, ties to health infrastructure strain. For readers monitoring global reserves or central bank moves, comment your interpretation of Saudi's SLV entry. monetary hedge or industrial prep? And what signals does it send for 2026? Infrastructure damage looms. Power grids, transport, silver in controls, batteries, face delays as 2025's 149 million-ounce shortfall forces rationing. The kill switch's failure cascades, trading halts like November's, when silver hit $54 pre-resume. Buy time, but erode trust. Media tiptoeing, focusing on rally, not disconnect, is signal, like pre-2008 silence on derivatives. Behavioral anomaly. Miners profit at $10.80 AISC, but output caps at 2%. Recyclers hit records, yet deficits widen. The system's tipping point. When arbitrage fails, as in $2.88 inversion, price discovery shifts east, Shanghai premiums dictating. The narrative builds to scale. What banks intended as containment becomes catalyst. 1980's rule flip worked in isolation. 2025's integrates with solar's 5,200-ton pull EV growth. Logistics, flights for bars cost 5%. Inefficient, but necessary. In break, value realigns. Cable ties secure more than silver bars when chains snap, holding 175 kilograms versus knots that loosen. History. Texas 2021 storm saw ties outvalue tape. Now, silver's squeeze previews broader loss. If you've experienced supply chain pinches in renewables or electronics, share in comments how silver costs are forcing adaptations. Does it align with official projections or exceed them? Control erodes where least expected. Regulators' inaction on limits amid $920 million fines echo suggests tolerance until unbreakable. The mess-up, kill switch, sparked the very run it aimed to stop, with deliveries up, inventories down. Military. Radar delays from shortages mirror World War II wound sutures via thread. Basics sustain when exotics fail. Geopolitics. India's tariffs, China's controls, reroute but constrict. The phase fixes. We're in detachment, heading to repricing. Silver's anomaly cascades to every day. Alfoil multiplies heat in blackouts, as in solar ovens baking without power. 2011 Japan quake saw foil as signals. Now, silver's deficit hints at similar. The system's fracture, papers 350 to 1 versus. Physicals scarcity. Banks' overnight change failed because demand's not levered. It's essential. For those in logistics or trading, if you're seeing airlifts or premium spikes firsthand, note in comments your take on sustainability. Temporary or new norm? The heavy close. This process phases in. Control lost inch by inch, until the break is total. No hysteria, just the logic unfolding. Deficits compound, interventions rebound. Reality asserts. Silver vaults at COMEX registered category dipped below 120 million ounces mid-December 2025, down from 250 million in September, while spot prices held above $66 after touching $66.87, levels that paper leverage ratios of 250 to 1 cannot sustain. Without physical backing, deliveries in the December contract already exceed 40 million ounces month to date, pulling metal that was supposed to underpin hundreds of billions in notional futures exposure. Shanghai premiums flipped to $5 to $8 over COMEX equivalents in early December, triggering cargo flights of bars westward. Yet the drain accelerates. This is not a rally contained by volatility controls. This is the physical market overriding the paper one, in real time, with inventories at multi-decade lows relative to open interest. The margin adjustment on December 11th, CME lifting initial and maintenance requirements 10% to $22,000 per contract for non-hedgers was framed as routine volatility management. But it landed precisely as prices breached $64, forcing leveraged longs to either post more capital or liquidate into strength. The result? A brief pullback to $61, then resumption higher, exposing the mechanism's diminishing returns. Banks and exchanges have deployed this tool before. 2011 saw hikes up to 84% amid the last major squeeze. But context differs profoundly. Then, demand was speculative. Now, it's embedded in solar modules consuming 261 million ounces projected for 2025 alone, EVs at 90 million ounces, and data centers scaling silver-loaded components exponentially. The intervention bought days, not resolution, because the underlying pull is non-discretionary. Fabricators cannot margin call their way out of needing conductive paste or battery contacts. History reflects the shift starkly. In 1980, backwardation emerged from one family's cornering attempt. Exchanges imposed liquidation-only rules, and the market collapsed because physical demand lacked structural roots. Today, inversion reached $2.88 in October, persisting into December despite arbitrage attempts, because industrial users, accounting for 64% of offtake, thrive on higher prices only to the extent they pass costs forward. Mine supply, 28% primary silver, responds sluggishly. Byproduct output from lead, zinc, or copper ties to those metals' economics. Recycling hit records at over 200 million ounces, yet the deficit narrows to 117 million ounces per Silver Institute, not from abundance, but from thrifting in panels and slight jewelry weakness. The system held when deficits were cyclical. It strains when they're perpetual, amplified by green mandates locking in consumption. Geopolitical threads tighten the knot. U.S. Critical minerals listing prompted precautionary inflows, while tariff threats rerouted flows, draining London vaults to 140-year lows earlier in the year. Shanghai inventories swung wildly. Outflows in fall, brief rebuilds, mirroring regional arbitrage that costs 5% in transport alone, yet persists because prompt metal commands premiums. Central banks added silver quietly. Saudi entries into SLV signaling diversification beyond gold. This isn't speculation, it's allocation, with institutions absorbing 130 million ounces into ETPS year-to-date, holdings at 844 million ounces. Silence from CFTC on position limits, amid echoes of past fines, registers as acquiescence to a market escaping containment. If you're in renewables procurement and watching silver paste allocations tighten or costs reprice contracts, share below how it's reshaping 2026 planning. Does the deficit feel like official 117 million ounces, or deeper in practice? Behavioral anomalies compound the pressure. J.P. Morgan halted leasing in fall, preserving vaults rather than feeding redemptions. Miners profit at sub-$11 AISC, yet cap expansion at 2 to 3% annually due to maturing deposits and permitting delays. Refineries ration, Perth Mint among them, echoing patterns from tighter eras but against record demand. The fracture widens where elasticity vanished. Contango once rewarded storage. Backwardation now penalizes it, incentivizing withholding. Lease rates spiked to 39% briefly, levels that scream scarcity, yet media frames the move as momentum buying rather than structural repricing. Compared to 2020's brief inversion amid refinery shutdowns, prices jumped 50% in months as flows restarted. Here, refineries run flat out, capacity bottlenecks intact, deficits baked for 5 years, cumulative, near 820 million ounces. Military logistics feel it too. Radar, missiles, quantum components flag delays in DoD assessments, reallocating from civilian to strategic. The chain reaction. Higher input costs cascade to panels, vehicles, grids, pass to consumers, or absorbed as margins compress. For those tracking ETF flows or vault data directly, comment your read on the 130 million ounce inflows. Defensive positioning or anticipation of higher equilibrium pricing? The progression reveals scale incrementally. Symptoms: margin fails to cap, deliveries surge, stem from causes delayed. Solar at near record despite thrifting, EVs rigid at 25 to 50 grams per unit, AI hardware scaling without substitute. Inverting again, the hike accelerated standing for delivery, as weak hands exited and strong accumulated. Logistics strain, airlifts inefficient yet necessary, mirrors historical sieges where basics outvalued assets, but scaled to global infrastructure. Value realigns under stress. Disposable tools, reliable in blackout. Trade premiums when grids falter. Needle thread sustains when supply chains snap. In 2025's squeeze, industrial hoarding of scrap previews broader shifts. Recycling jumps, yet gaps persist. Banks's tool backfired because demand isn't levered out. It's essential, growing 3 to 7% in key sectors. If you've observed regional premiums or delivery delays in electronics or defense, drop your ground-level signals below. Is the tightness uniform or fracturing unevenly? Control slips at the margins first. Regulators calibrate hikes to volatility, yet each iteration erodes credibility when prices resume. The mess-up compounds. Intended coolant becomes accelerant. Physical asserting dominance. Geopolitics interlaces. Tariffs, controls, constricting without collapsing. History mirrors distorted. World War II repairs via basics. Now, silver's antibacterial ties to strained health infra. The phase solidifies. Detachment matures into repricing. Paper yielding to physics. Deficits layer. Interventions rebound. Reality prevails. No resolution without higher clearing levels. The process advances, inexorably, control relinquished segment by segment until the reconfiguration completes. Spot prices touched $66.87 on December 17, 2025, closing near $66.52 after a 4.36% daily surge, while COMEX vaults hold record levels above 530 million ounces. Yet physical premiums in retail channels spike irregularly, and lease rates fluctuate wildly before easing. Deliveries in the December contract accelerate, but the bulk routes through house accounts at major banks, not dispersing into open market hands. This is not containment failing outright. This is the system absorbing shock through concentrated channels, redistributing strain without immediate collapse, as paper leverage holds, but physical signals flash intermittently. The CME's December 11th margin hike, lifting requirements roughly 10% across front months, was positioned as volatility calibration, yet it coincided with prices testing $64, prompting brief liquidations before resumption. The pattern echoes prior interventions, but the backdrop shifts. Industrial offtake, projected at 665 to 680 million ounces for the year per updated estimates, remains rigid even amid thrifting efforts in photovoltaics. Solar alone accounts for over 260 million ounces, EVs nearing 90 million, with data centers adding incremental pull. The hike extracted some leverage, but strong hands, ETFs at 844 million ounces holdings, absorbed dips, exposing how interventions now yield diminishing deterrence against structural buyers. History distorts in the reflection. 1980s inversion stemmed from concentrated speculation, resolved by rule imposition because demand lacked permanence. 2011's milder squeeze faded as economic headwinds curtailed industrial growth. Here, deficits layer cumulatively. 149 million ounces projected for 2025 per Silver Institute forecasts, fifth consecutive year, while mine output stagnates near 820 million ounces, recycling bridges only partially. The anomaly persists not from one-off positioning, but from demand's inelasticity. Green mandates lock in consumption. Byproduct supply ties to base metals' slower cycles. Earlier tools sufficed when deficits were transient. Now, they delay, but don't deflect the repricing pressure.